What if the interest rate cuts you built your entire 2026 portfolio around didn't just get delayed, but literally vanished into thin air in a matter of weeks? Because right at the start of the year, Wall Street was entirely confident. They had 4 consecutive rate cuts priced right in. The whole financial ecosystem, from your local mortgage lenders all the way up to massive sell-side desks, structured their capital on this absolute assumption that inflation was cooling and cheaper borrowing costs were just over the horizon. Well, those cuts are gone, completely gone. Traders are now actively pricing in a 40% probability of an outright rate hike. Think about that. That is a violent reversal for an economy that supposedly just finished an easing cycle. The whole path implied by the options market has shifted dramatically higher, and it's pointing to an extended hold or, honestly, active tightening. And this historic repricing of the global yield curve, it is forcing an absolutely massive capital shift under the surface. We're watching institutional money quietly abandon high-growth tech sectors right now. They're executing this highly calculated, highly defensive rotation because that foundational assumption of 4 rate cuts just violently collided with a highly restrictive reality. But this macroeconomic pivot didn't just happen out of nowhere. It was triggered by a very specific, rapid chain of events. The core catalyst here is a severe supply-side energy shock coming out of the Middle East. And the transmission of that shock is just brutally efficient. Month 1, blockades in the Strait of Hormuz disrupt global shipping. Since a full 20% of the world's oil flows through that exact strait, global reserves just start plummeting at a record pace. By month 2, Brent crude rockets past $110 a barrel. That acts like an immediate, unavoidable cash tax on domestic consumers, sending gas prices up nearly 50%. Then the compounding effect takes over. By month 3, wholesale pressures surge, driving the producer-priced index up to a 6.0% annual rate. And finally, by month 4, this energy surge fully infiltrates consumer metrics, dragging headline CPI up to 3.8%. This stubborn economic data effectively boxes policymakers in completely. But hold on. Energy is really only half the equation. The structural fiscal deficit is currently running above $1.7 trillion annually. That requires continuous, relentless net treasury issuance. So the market is staring down an unprecedented supply-demand imbalance, especially since the central bank is concurrently shrinking its balance sheet. This mechanically forces the bond market's hand, and it's entirely independent of any executive pressure or, frankly, whoever happens to be sitting in the central bank chair. That massive structural imbalance has pushed the benchmark 10-year Treasury yield up to a 15-month high of 4.631%. I want you to really let that number sink in for a second. That specific yield is the primary pricing anchor for domestic 30-year fixed mortgages and major corporate debt refinancing. Capital flight from government debt is driving these long-term yields higher, and that is creating severe valuation pressure across every major equity and corporate credit market out there. And the fallout from this sudden shift has radically split Wall Street's largest institutions. Goldman Sachs still projects a restrictive stance with some easing late in the year. Morgan Stanley, they anticipate an extended pause deep into March 2027. Bank of America pushes that restrictive hold all the way to the second half of 2027. Meanwhile, Yardeni Research anticipates an immediate shift to outright tightening as early as July. This extreme divergence tells us everything we need to know about the profound uncertainty currently sweeping through the entire financial system. You take all that uncertainty and you add a thick layer of macro risk premium right on top. Look at the recent 54-45 Senate confirmation vote for incoming Fed Chair Kevin Warsh. If we treat this strictly as an institutional friction metric, a historically partisan confirmation like this signals a highly polarized leadership transition. For market participants trying to model risk, this internal division acts as an additional layer of volatility pricing. The new chair has to navigate a fractured policy committee, where multiple voting members are already pushing for much stronger hawkish language. He's stepping into leadership under intense executive branch rhetoric, demanding immediate easing to support growth. Yet hard economic data ultimately binds those policy choices. With structural consumer inflation hitting 3.8% and wholesale inflation climbing to 6.0%, any premature attempt to artificially lower short-term rates risks completely unanchoring long-term inflation expectations. Ironically, doing that would trigger an even more aggressive bond market sell-off, which would paradoxically drive real-world mortgage and refinancing costs even higher. If you're wondering about the exact mechanics driving the retail tech panic we're seeing, it all comes down to pure mathematics. Rising risk-free rates mathematically compress equity valuations. For any long-duration asset, distant future cash flows have to be discounted. So as that risk-free rate climbs, the present value of those distant earnings just plummets. This absolute mathematical certainty is exactly why high-growth tech and speculative stocks are always the first to bleed in a higher-for-longer regime. So how is the smart money reacting? To insulate their capital from this macro regime shift, institutional asset managers are executing a highly calculated defensive rotation. They're actively trimming 5 to 10% from broad tech and growth indexes. Where is it going? They're aggressively adding to floating rate debt instruments, things like FLOTs, where the coupons adjust dynamically with the federal funds rate to basically wipe out interest rate risk. They're also overweighting energy assets, like XLE, because those companies actually have the pricing power to pass rising supply-side costs directly onto the consumer. But look under the hood, and there is a really striking divergence occurring right now. We have this aggressive, panicking sell-off in the sovereign bond market, and yet the US dollar index, the DXY, is just stagnating. It's essentially trading flat year to date. Usually, a hawkish pivot and rising yields trigger a huge rally in the domestic currency. The fact that it's flatlining signals that global foreign exchange traders are actually terrified that sustained high borrowing costs will cause severe domestic credit disruptions, effectively forcing the central bank to reverse course anyway. Which brings us to a deeply counterintuitive, data-driven policy scenario that people are calling the Volcker paradox. It sounds completely backward, I know, but the theory suggests that a proactive, preemptive 25 basis point rate hike in July could actually lower real-world borrowing costs. The logic is that by acting as a fierce inflation hawk early on, that display of credibility immediately soothes bond market anxieties, driving long-term 10-year Treasury yields back down. And since mortgage rates are tied directly to that 10-year yield, not the short-term federal funds rate, an aggressive short-term hike could, paradoxically, deliver the lower long-term borrowing costs the executive branch is demanding. The secondary probabilistic scenario we have to weigh is an extended restrictive hold. That means keeping the benchmark rate completely flat at 3.50% to 3.75% deep into 2027, just forcing a slow economic cooling process. For serious market participants, the key here is monitoring specific, hard labor metrics. This high-for-longer prediction would be totally invalidated if we see a sharper than expected rise in unemployment or a sudden, severe spike in corporate layoffs. That would signal a hard recession and force the committee to panic pivot back to easing. Though responsible market analysis means we have to acknowledge all the nuances in the data. Providing a brief moment of breathing room right now is the Dallas Fed's trimmed mean PCE, which is sitting significantly lower at 2.3%. This metric is a crucial reminder that if underlying inflation trends actually start to cool off, once these temporary tariff and geopolitical energy shocks wash through the system, well, the calls for an outright interest rate hike might end up being a massive overreaction. Let's zoom out for a second, because we're staring right at the core, unresolved economic puzzle of our time. Central banks simply do not possess absolute control over real-world borrowing costs. Sure, policymakers control the short-term federal funds rate, but commercial loans and mortgage pricing are anchored directly to long-term sovereign debt yields, and those are determined strictly by the open market. In an era dominated by structural fiscal deficits, if private credit markets lose confidence in price stability, capital flight will drive yields higher, tightening the entire financial system regardless of what official directives say. So, as the global yield curve radically realigns itself, and as institutional capital flows heavily toward defensive stability, we are left with a fascinating structural contradiction. The sudden, violent shift from 4 priced-in rate cuts to a 40% chance of a rate hike proves that external commodity shocks and massive structural deficits completely overpower Wall Street's baseline assumptions. In this era of absolute fiscal dominance and shifting yields, which macroeconomic vector do you believe is going to break first?
An investment in knowledge pays the best interest, so why not invest in this channel? Click like and subscribe for more.